Cryptocurrency provides the potential for outsized gains, although price volatility can cause losses. Investors should only invest an amount they can afford to lose. Your time horizon is another important factor to consider. Ideally, a long-term investment will help reduce the risk of large fluctuations. Cryptocurrencies appear uncorrelated with traditional stock and bond markets, making them a potential source of portfolio diversification. 1. The potential for huge profits. Investors buy cryptocurrencies in the same way that they buy stocks or houses, hoping that their value will rise, netting them a profit. However, cryptocurrencies are much more volatile than stocks. It's not uncommon for them to lose or gain 10% in a single day. For this reason, they're better suited to investors who are willing to hold on to their investments for the long term. One of the main reasons that people invest in cryptocurrencies is because they can be sent from one person to another without the need for middlemen, like banks or money transfer companies. This is especially useful in developing countries where these services are scarce or expensive. Additionally, some people use cryptocurrencies as a form of hedge against inflation in fiat currencies, such as the US dollar or the euro. Cryptocurrency's potential for huge profits is also why it has become popular with traders and people who want to diversify their portfolios. However, it's important to remember that cryptocurrencies are still very new and speculative, so it's important to research thoroughly before investing in them. It's also worth pointing out that unlike stocks, cryptocurrencies have no intrinsic value. Their prices are determined by the interplay of supply and demand. As a result, they're susceptible to the same types of market forces that can drive down the price of any other commodity. In other words, they're not backed by any underlying assets or earnings and are therefore much more volatile. They also have no yield and aren't a reliable source of income, so they should only make up a small part of your overall portfolio. 2. Ease of transactions. Cryptocurrency is a digital token that allows people to send money directly to one another over the internet without any central authority or middlemen. It is secured by cryptography and operates on blockchain technology, a distributed ledger enforced by a disparate network of computers. This makes it nearly impossible for hackers to manipulate the cryptocurrency system and allows for transparent, immutable record keeping. The emergence of cryptocurrencies has prompted many people to invest in them, but there are several factors to consider before making a decision. First, investors should determine what their investment goals are and decide whether cryptocurrency is a good fit. In addition, they should take the time to learn about the different currencies offered and understand how the technology works. There are plenty of resources online that can help, from primers written for non-technical audiences to technical white papers. Finally, investors should research the different platforms and services that offer transactions in a given cryptocurrency. While it is important to do your research, you should also remember that the value of a cryptocurrency depends on investor interest and speculation. This can lead to high volatility and price fluctuations. However, if you invest wisely and do your homework, you can earn large returns on your investment. As the cryptocurrency market continues to grow, understanding investor behavior is essential. This study uses partial least squares structural equation modeling to examine the relationships between cryptocurrency awareness, perceptions of usefulness, and adoption. The results suggest that awareness plays a direct role in driving cryptocurrency adoption and is mediated by perceptions of usefulness. Additionally, the results also show that trust plays a moderating role in this relationship. 3. The potential for decentralization. When investing in cryptocurrencies, investors are purchasing digital alternatives to money created and controlled by governments. While the technology behind cryptocurrencies is new, they have the potential to revolutionize how we invest and bank, and even how we pay for goods and services. Cryptocurrencies can be bought, sold, and exchanged using a variety of tools that are designed to be secure, fast, and reliable. They can also be used to make anonymous transactions, and they often have built-in protections against fraud and hacking. However, like any investment, they carry risks, including a risk of price volatility and market manipulation. Another benefit of cryptocurrencies is that they are not controlled by any central authority. This means that they cannot be manipulated by governments or other organizations with an agenda, and there is no risk of inflation or artificial economic growth. As a result, they have the potential to be a stable store of value. Moreover, many cryptocurrencies use blockchain technology to create decentralized financial applications, DeFi. This can eliminate the need for traditional intermediaries and reduce rents in the finance sector. This has the potential to democratize finance and unleash a wave of innovation. While DeFi is transforming the finance industry, it still requires some level of oversight. For example, despite claims of decentralization, some crypto assets are actually controlled by large investors, venture capital firms, and whales. In addition, the lack of regulations means that there is little to protect against bad management practices or platform flaws. Ultimately, it is important for policymakers to take a proactive role in regulating the crypto sector. Otherwise, the booms and busts of crypto could have major repercussions for the broader economy. 4. The potential for privacy. Cryptocurrencies are a new type of asset that, like cash, is a store of value, but also, unlike traditional stocks and bonds, can be used as an investment. As such, they can generate significant returns, but they also carry the same risks as other investments. Before investing in cryptocurrency, investors should consider their budget, risk tolerance, and investment strategy. Investors should be cautious about any claims of a guaranteed return or profit. Anyone who makes such claims is likely trying to swindle you. In addition, cryptocurrencies are often the target of fraud schemes, such as pump and dump scams, which involve a rapid increase in the price of a coin followed by a quick drop in price. In order to avoid these types of scams, it is important to thoroughly research any cryptocurrency before investing. You can do this by searching for the company or cryptocurrency on the internet and looking for reviews, complaints, and other relevant information. Another thing to keep in mind is that cryptocurrencies are not backed by any kind of physical assets or cash flow. As a result, they are extremely volatile and may not always return a positive return. Investors should invest only what they can afford to lose and should diversify their portfolio to minimize risk. There are many reasons to invest in cryptocurrency, including the potential for huge profits and the ability to easily make transactions. However, investors should be aware of the risks involved and should consult with a licensed financial advisor before making any decisions about their investments. Additionally, investors should be sure to take steps to protect their digital assets, including storing them in a secure wallet. 5. The potential for regulation. The explosive growth of cryptocurrency has prompted regulators around the world to consider ways to protect investors. However, it's important to remember that government regulations around crypto are constantly evolving and may differ based on where you live. This can lead to volatility and uncertainty in the marketplace. It's also worth noting that cryptocurrency markets aren't regulated in the same way as traditional stock exchanges or banks. This makes them more susceptible to scams and can create a much less transparent investment environment. As such, it's crucial to research any cryptocurrency or trading platform thoroughly before investing any money. In the past year, crypto trading has seen massive losses and scandals that have sparked calls for increased regulation. Whether or not those demands are warranted is yet to be determined, but it's clear that the crypto industry needs to improve its regulatory oversight. One of the most pressing issues is how to categorize cryptocurrencies. Many experts believe that most cryptocurrencies should be considered as securities, but there is disagreement on how to proceed. Some argue that cryptocurrencies should be classified as commodities, while others say that they should be treated more like property. The difference is significant because it can have major implications for how cryptocurrencies are regulated. Another issue is how to regulate crypto traders and platforms. Some experts have called for self-regulatory organizations to be created, while others have argued that a new federal agency should be established to oversee the industry. The bottom line is that there are many unanswered questions about how to regulate crypto and how to do so in a fair and consistent way. This will have a huge impact on the future of the industry and could limit its growth potential.